What's up, everybody? Welcome back to Market Minute, where we break down what's happening in the markets and find those hidden opportunities that could pay off big time. Today, on August 22nd, 2025, we're diving into popular stocks that have taken a serious beating, but might be gearing up for a major comeback. It's easy to get caught up in the hype when stocks are soaring, but the real money is often made by being patient and buying into solid companies when everyone else is panicking. It's about finding that disconnect between a company's long-term potential and its current beaten-down stock price. We're going to look at 5 specific companies today that fit this exact description. These aren't just random picks, established players and innovative disruptors in their respective spaces. I've done the research, sifted through the noise, and I believe these names present a compelling case for a long-term hold. We'll explore why they dropped, what the risks are, and most importantly, why the potential upside could seriously outweigh the downside from here. Remember, nothing is guaranteed in investing, so this is all for your entertainment and to get you thinking. The market has been a roller coaster, and a lot of the high-flying tech names from a few years ago are now trading at significant discounts. This can be scary for sure, but it also creates a window of opportunity. When fear is high, prices are low, and that's the time to start paying attention. First up, we have a name you might not immediately think of as a tech stock, but trust me, its future is deeply tied to technology: Nike. Right now, Nike is trading significantly down, over 50% from its all-time high of around $179. That's a massive haircut for a blue-chip company of this caliber. The drop isn't without reason. The bears will point to slowing sales in key markets like China, increased competition from up-and-coming brands, on-running Hoka, and persistent inventory issues that have forced them into heavy discounting, which hurts their profit margins and brand prestige. However, this is where the opportunity comes in, and the bullish thesis is compelling. Nike is investing billions into technology to transform its business. Think about their direct-to-consumer strategy, powered by their SNKRS app and website. They are collecting immense amounts of data on consumer preferences. Nike still has one of the most powerful and recognized brands in the world, with massive sponsorship deals and a global marketing machine. Next on our list is the software powerhouse, Adobe. This is a company that's basically a monopoly in the creative software space with its Creative Cloud suite. Despite this dominance, the stock is down about 40% from its all-time high of nearly $700. So what happened? The primary driver of this decline has been the emergence of generative AI. Investors are terrified that new, nimble AI tools for image, video, and design creation could disrupt Adobe's core business. However, the bullish case for Adobe is that the market is severely underestimating its ability to integrate AI into its own ecosystem. Adobe has been aggressively developing and embedding its own generative AI, called Firefly, directly into its flagship products. Instead of being a standalone tool, Firefly is integrated into the workflows that millions of professionals already use and trust. This allows creators to use AI to enhance their work within a familiar, powerful, and legally safe environment. The company's massive user base, enterprise relationships, and deep integration into professional workflows create a formidable moat that new AI startups will struggle to penetrate. Now for something a little more speculative but with incredible long-term potential, Joby Aviation. Joby is a leader in eVTOL development, basically flying taxis designed for fast, quiet, emission-free urban transport. Classic high-risk, high-reward play trading more than 60% below its all-time high. Reason for the drop: skepticism and delays. Industry built on promise, no meaningful revenue yet. Investors impatient with long timelines for FAA certification and commercial operation. Bullish thesis rests on massive market size and Joby's leadership. Progress: completed Stage 3 of 5 in FAA type certification and delivered their first aircraft to the U.S. Air Force for testing. Bullish case boosted by strategic partnerships and funding. Toyota provides manufacturing expertise, Delta Airlines investment and shuttle plans. Partnerships provide capital and validation plus operational expertise. For long-term, high-risk investors, buying here is a bet they become a defining company of the next decade. The risk is high, but the potential reward is astronomical. Let's shift back to a more established tech sector with our fourth pick, CrowdStrike Holdings. CrowdStrike is a leader in cloud-native endpoint security, protecting laptops, servers, and cloud workloads from cyber attacks. Even with its stellar reputation, the stock has fallen nearly 35% from its all-time high. The main reason for this pullback is valuation concerns mixed with fears of a slowdown in enterprise IT spending. The bearish arguments center on two main points. First, the cybersecurity space is incredibly competitive. SentinelOne, Microsoft, Palo Alto Networks. There's a constant fear a competitor could develop a superior product or pricing pressure could erode CrowdStrike's margins. However, the bullish thesis for CrowdStrike remains incredibly strong. Cybersecurity is no longer discretionary, it's a fundamental necessity. CrowdStrike's Falcon platform is widely considered the gold standard, built from the ground up for the cloud era. It's not just an endpoint security company anymore. Cloud security, identity protection, data observability. Customers who start with one module often expand to many more, driving up net revenue retention. Our final pick is a company that has been on an absolutely wild ride, Supermicro Computer. Supermicro specializes in high-performance, high-efficiency servers and is a key partner for AI chip giants like NVIDIA. The stock experienced a meteoric rise, but is now trading down about 45% from its peak earlier this year. The drop was triggered by a combination of factors, including profit-taking after the parabolic move, short seller reports, and accounting issues. The bearish case highlights customer concentration as a major risk. If one of its key clients decides to switch suppliers or build its own servers in-house, it could have a devastating impact on Supermicro's revenue. Despite these concerns, the bullish thesis for Supermicro is tied directly to the unstoppable growth of artificial intelligence. AI models require an immense amount of computing power, and Supermicro has positioned itself as the go-to provider. Their key advantage is speed and customization. They work very closely with chipmakers like NVIDIA and AMD, allowing them to bring servers with the latest technology to market faster than larger competitors. The AI build-out is still in its very early innings. We are talking about a decade-long infrastructure investment cycle, and Supermicro is at the heart of it. For investors who believe in the long-term AI revolution, getting into Supermicro after a 45% pullback offers an attractive entry point. And that's a wrap for today's Market Minute. Thank you so much for tuning in. I hope this breakdown gives you some valuable ideas to research further. As always, do your own due diligence before making any investment decisions. If you found this helpful, make sure to smash that like button and subscribe for more updates on market opportunities. Until next time.